When markets turn cautious, the shift is rarely driven by abstract economic data. Global financial volatility is frequently anchored in geographical bottlenecks. The Strait of Hormuz is the primary anchor of this risk. It is a narrow stretch of water situated between Iran and Oman. At its tightest point, the entire passage is barely 33 kilometers wide. A massive share of global energy trade depends on a shipping lane narrower than the width of many cities. Because of these extreme constraints, military activity in this specific region instantly forces global shipping companies to halt operations due to uninsurable maritime risk. Military retaliation in these waters paralyzes the main artery through which Gulf energy reaches the rest of the world. A 33-kilometer stretch of water sets the baseline risk premium for the entire global economy. This dependency is defined by the volume of trade. Every day, roughly 13.4 million barrels of crude oil exports cross this strait. The vast majority of that crude originates from Saudi Arabia, Iraq, and the UAE, which account for about 13.1 million barrels daily. When adding refined fuels, the total daily flow relying on this passage reaches an aggregate of 20 million barrels. This waterway is equally critical for global natural gas supplies. Roughly 80 million tons of liquefied natural gas, or LNG, pass through the strait every year. LNG is gas cooled to a liquid state for easier transport. This represents nearly 19% of the entire global supply. Disruption here targets 1/5 of the world's total energy matrix. A choke point crisis begins as a logistics failure. The oil is still being produced. It simply has no viable route to leave the region. Marine insurers are the first to react, pulling back coverage and refusing to underwrite vessels entering an active conflict zone. Without that insurance, shipowners will not take the financial risk. Hundreds of oil and LNG vessels are forced to drop anchor and wait outside the strait. The market does have a temporary safety buffer. There are about 7.8 billion barrels of visible oil inventory globally, which can absorb a short-term delay in shipping. This buffer is finite. When ships stop moving, regional export terminals and storage tanks quickly fill to absolute capacity. Once those tanks overflow, Gulf producers must slow or cut their daily production. Massive global inventories only buy time. Eventually, the physics of full storage tanks mandate a transition from a shipping traffic jam into a hard global supply deficit. Markets often assume Gulf states can bypass a blocked waterway by rerouting their oil over land. Saudi Arabia and the UAE do possess pipeline infrastructure designed specifically to reach alternative ports on the Red Sea and the Gulf of Oman. However, the existence of those pipes does not solve the mathematical reality of their volume limits. These overland routes can handle a maximum of roughly 5 million barrels per day. That leaves 15 million barrels per day completely exposed with zero alternative routing options. Furthermore, the Gulf exports a massive volume of non-crude products, petrochemicals, fertilizers, and aluminum. These cannot use oil pipelines, meaning they are stranded entirely. Pipeline bypasses slightly blunt the initial shock, but they cannot prevent a catastrophic global bottleneck. The global oil market relies on one final theoretical safety net: spare production capacity. It's the ability to rapidly pump more oil to stabilize prices. Currently, the world has approximately 3.7 million barrels per day of unutilized production power available. The vast majority of this emergency capacity is clustered inside Saudi Arabia and the UAE. This creates a paradox. Even if producers decide to pump this emergency oil, it still has to travel through the exact same blocked shipping corridor to reach the global market. The world's primary energy safety net is nullified because it is geographically trapped behind the very choke point causing the crisis. Once the physical energy supply is constrained, a wave of financial contagion immediately infects the entire global shipping industry. Friction multiplies rapidly as war risk insurance premiums surge, and vessels are forced to take significantly longer, rerouted journeys around entire continents. Fuel accounts for roughly 35% of a ship's operating costs. When a supply squeeze drives fuel prices up by 40 to 50%, overall maritime freight rates are forced up by another 20%. Because maritime shipping costs feed directly into the price of traded goods, these increases eventually show up as global inflation. Under a severe scenario where oil moves toward $100 per barrel, the combined weight of energy shortages and shipping friction adds roughly 0.7 percentage points to global inflation.
To see how this inflation attacks import-dependent economies, we can look at India as a prime macroeconomic case study. India imports 85% of its total crude oil requirements to maintain economic activity. This chart reveals a hyper-concentrated risk. 40% of these vital Indian imports rely exclusively on the Strait of Hormuz. High oil prices expand India's current account deficit when imports exceed exports. This deficit triggers currency volatility, putting direct downward pressure on the rupee. Friction at a distant 33-kilometer choke point acts as an immediate, systemic tax on the entire Indian macroeconomic system. This national macroeconomic drag translates directly into vulnerability in the stock market. Current assessments show that a full 20% of the Indian equity market is negatively exposed to this specific geopolitical risk premium. Because this exposure is built into the geography of global trade, institutional investors are forced to execute defensive sector rotations, pulling capital out of vulnerable industries. To navigate this environment, investors must track three critical forward-looking indicators: crude oil spot prices, global LNG futures, and freight rate volatility. When these metrics spike, the resulting market pessimism is not blind panic. It is the calculated pricing of undeniable geographical bottlenecks. By tracking the exact mechanics of these geopolitical choke points, investors can look past short-term volatility and correctly price long-term fundamental value.